Welcome to Freed on Business. He grew up in South Florida, has been in business here since the early 90s, and has closed over $3 billion in deals. He's seen it all. He always has an opinion, and he's always ready to share it. Informed, entertaining, and connected, he has his finger on the pulse of South Florida's business community. He's Jim Freed, and this is Freed on Business.
Hi, everybody. Welcome to Freed on Business. This is episode 883, right? Okay, 883. We're in the deep summer doldrums. It's the last quiet day in Miami. The clouds are forming. The trees are blowing outside. It's about to pour rain, and it's going to flood out the neighborhood. We're going to talk a little bit about interest rates today and what's changed since the beginning of the year in just the last few months. I want to thank our friends at Warren Henry Automotive. Thanks to Gerald. Thanks to Brandon, Larry, Eric, Ismet, and of course, the main man, Warren himself, Warren Zinn. Thank them for sponsoring us for 15, almost 20 years now. It's great to be a member of the Warren Henry family and to be their brand ambassador. I want to remind everybody that if you missed today's podcast, you can catch us on all the different podcast platforms. And, of course, you can watch us live on LinkedIn, Facebook, Instagram, and Twitter. I guess we're really not live on Twitter. But in any event, you can find us everywhere. If you Google Jim Freed, you'll find me. Everybody with the name Jim Freed can't stand me because they're on page 4 of the Google search. And now on with the show. As I said, is about interest rates. At the beginning of the year, everybody was predicting interest rates would go down. Trump was going to get rid of the Fed chair, put in one that was more interested in lowering your interest rates, and he was jawboning everybody that rates were going to go down. And then the war in Iran hit, and energy shock came, and interest rates are at least being held steady. And if there's inflation, you could almost say that they're going to go up. But let's assume that rates are going to calm down and that they're going to start drifting down right after the election. If rates fall in 2027 for the residential real estate sector, won't dramatically decline on a one-for-one basis with the interest rate cuts with the Fed. Residential rates aren't indexed to the Fed; they're indexed to the corresponding Treasury. So you'll see a gradual decline in interest rates. Won't really impact Miami, where everybody buys for cash and most people are relocating, and they look at buying their home or condo in Miami as getting it for free after they deal with the income tax issues. But as rates continue to drop, more first-time buyers will enter the market. I'm right now working on a residential loan with a friend of mine's son, actually, about $350,000 purchase. We're going to help that person get their loan. It certainly won't be in the threes, and I don't think you're going to see the threes anytime soon. I think you'll still see things in the maybe mid-fives if rates drift down a little bit. Home prices will hopefully stabilize. And in areas with strong growth, home prices would actually increase. Commercial real estate, a little bit more complex. It's more project by project. The real question in commercial real estate is, where is the equity? There's lots of debt out there, but people need equity. I'm dealing with a lot of family offices that are looking to do transactions with people. We're in the debt market right now. Thank goodness they're flush with equity, so I can go to the best lenders and have somebody who can give a guarantee, a personal guarantee, and also put equity in the deal. Industrial and logistical properties, for the most part, are remaining strong. However, demand for new construction has slacked considerably. In the multifamily sector, this sector would definitely benefit from lower rates. Many of the transactions were built in 24, 25, assuming that rates would go down and that people would be able to finance out. One of the reasons there's not a lot of equity in the marketplace is because people have not been able to refinance out of the apartment market and the industrial market. That's why we're seeing a lot of people that would usually hold, putting their property on the market before it's fully stabilized and having to take a price decline. I have lots of family offices, lots of institutions that would like to buy properties right now. But the reality is that until rates drop, it's going to be very sticky in that marketplace. Just got to email from somebody who wants to talk to me about financing one of the shopping center development deals I'm working on. So I do have institutional capital for the shopping center market. I've got incredible debt for shopping center construction. The issue with shopping center market is that the industry has consolidated so much over time that many of the people are institutional owners. That does bode well for my EV charging concept, though. We're talking to a lot of institutional owners, and we're getting great traction. They all want us to quote on their properties to put chargers out there, and our chargers are typically a great addition to the bottom line that they did not expect. I got 5 new submissions earlier today. So retail is continuing to be strong, especially in markets where there's a constraint in supply and where the retailers themselves want to be. They're willing to take transactions they didn't take in the past simply because there's not a lot of good opportunities left, and specifically in the green areas in the eastern Tampa, St. Pete, Bradenton, Sarasota, Fort Myers area, going really strong there. And in areas where you can find it in Dade, Broward, and Palm Beach counties, you got a different type of retail there, but retail is really strong right now. It's what we're focusing on now. Office buildings, older downtown properties are continuing to have problems. You saw in New York City, one of the conversions had a problem because it wasn't, I don't know, I'm just watching from the sidelines. It appeared as though it wasn't structurally supported correctly when they tried to demise it for residential. Most of these office properties don't really work for residential, and we're getting to the point where new office properties can be built because of the demand that we've seen in certain submarkets. Talk about Miami. I have a family that's specifically focused on providing equity and generating new construction in the super luxury office market. Their most recent rents have surpassed $200 a foot, and I think we're going to need to get on Brian Gale and hear more about the upscale office market after Labor Day. And then, of course, there's the other industries that are capital intensive, loan intensive. Those industries are really affected by interest rates because interest rates define the monthly payment. So a lot of people are locked out. You know, we had in economics, you saw supply and demand and how elastic or responsive it is to interest rates. Many industries that are related to interest rates are going to have a problem. I think you'll see a slowdown in consumer spending as consumers reach the breaking point on their credit cards. Got to realize that 0% interest rate that they got sucked in with is going to translate into 30, 35%, and they're going to have a problem refinancing. And if they really look bad, they'll have a problem even rolling it over to a different long-term low interest or no interest teaser rate credit card. That's why I'm working with a number of people right now to pull equity out of it. And I'm going to go equity out of their house because until you pull it out, you don't have anything. We're working with some people that are buying homes that are putting first mortgages on. We're working with some people that have already bought their homes or condos. They're putting first mortgages on, even though the rates are double what they were just a few years ago. They're still relatively low compared to 30-year averages. And then, of course, we're working with a number of people that are looking to pull money out right now through a HELOC, because the reality is that if certain marketplaces slow down and people don't make their income targets, they're going to have a hard time borrowing next year. Because if you have if your income's starting to trend down, people are going to stay away from you unless, of course, you have W-2 income. So there's a lot of uncertainty in the interest rate market. But if you have something that you want to execute, give me a call. I know the best lenders, the best equity investors, the best family offices, they all pick up the phone. They all say, Jim, we'll take your call. We'll send you this deal because we love you. You're just like family. And that's what it is. That's the brand of Jim Freed on Business. We co-brand with Warren Henry. We're their brand representative because they treat you like family. Just got back from Warren Henry. Thanks again to Gerald. You'll see me post a beautiful video thanking Gerald later this week. And I want to remind everybody, check us out on all the different platforms. We'll come back with the bottom line right after this. Miami Podcast Studios. Help me talk about my good friends at Warren Henry Automotive. I want to remind everybody that our good friends at Warren Henry have been a sponsor for quite some time, 15, 18, I lose track of how many years it is, but I want to thank Larry, Eric, Warren, Ismet, and I want to talk about Brandon today. Brandon is the F&I guy. When you go to Warren Henry, Brandon will help you craft your transaction so that it fits your budget. Brandon is a wonderful young man. I really can't tell you how much I love him. He's Eric Day's. He's part of Eric Day's family. Eric is one of the leaders at Warren Henry Automotive. So when you go over to Warren Henry, you're almost always going to deal with one of the family members, and they will treat you like family. Right now in today's world, it's important to get that kind of support when you go into a store, especially when you're looking to make a big capital purchase like an automobile. They'll craft the best loan for you. They'll craft the best price for you. They'll make the transaction seamless and painless. And when you're done, you get your Warren Henry Automotive serviced by my good friend Gerald Henry. I just realized today that it's Gerald Henry. He's part of the Warren Henry family. I asked him if he's related to the Henrys, Warren Henry and all that stuff. It's kind of cute, actually. I love that guy. So remember, whenever you're looking to buy or lease a car, you want to get every advantage that you can. You also want to be treated like family. That's really the Warren Henry advantage. They treat you like you want to be treated. When you go in there, it's always all about you. They've got their headquarters store on Biscayne and 151st. I was just up there earlier today. Land Rover, Range Rover, Jaguar, Lincoln. My Lincoln is so tremendous. I love it. It's a hybrid. It just is so great. It adds 25% to the mileage when you fill up your tank just having that hybrid. They have a great store down in the Keys that sells all their great nameplates. They've got an award-winning Land Rover Range Rover store in South Dade, another one out in Broward, West Broward. So remember, always join me, my beautiful wife Vivian, my mom, lots of my family members, lots of my clients, lots of my friends. They're all members of the Warren Henry family. You should be too. Always the best price, always the best service, always Warren Henry.
Welcome back to Freed on Business. Connect with us on LinkedIn, YouTube, Facebook, and Twitter at Jim Freed or at Freed on Business, and on Instagram at JimFreed1. Now, back to your host, Jim Freed.
Hi, everybody. I want to remind everybody, if you missed today's episode, you can check us on Apple Podcasts, YouTube. That's my preferred place. I love watching myself on YouTube. And all the other streaming services. So go to your favorite streaming services, search for Jim Freed, search for Freed on Business. You'll find us, and you'll get some great content. You'll get some great energy. And I want to remind everybody, people reach out to me. They call me. They email me. I work with a lot of families, high net worth families that are looking for capital or to create their business plan or execute their business plan. I bring a lot of gray hair to the table. I have a lot of great experience, and I'm happy to bring that to your multi-generational family or your real estate business or your institutional real capital deployment vehicle that you have operating. So reach out to me, give me a call, send me an email, and remember, whenever you call me, it's always all about you. And now back to the show. We're going to talk about the bottom line. We've been talking about interest rates. It used to be when I graduated college, back when they were inventing the wheel and fire, they thought that everything moved in lockstep. The reality is that every component of the economy works differently, and a lot of them have different sensitivities to interest rates. But as we sit here in the studio today, it's deep summer. It's the beginning of August, and the clouds are gathering in the sky. There's a big thunderstorm warning. The trees are literally bending over like this, and there's a storm coming. So can we predict what's going to happen with interest rates? The answer is no. If I could predict what would happen with interest rates, I'd take my crystal ball that I'm not holding and I go to Las Vegas and win. But the reality is you got to make plans and you got to do things that make sense to you. So while everybody thought that interest rates were going to go down this month, this year they haven't. So when they start going down next year, which I'm God willing hoping they will, that'll mean that things have calmed down after the election. People have stopped using the economy and the individuals in our country as a punching bag, both sides, all sides. There's so many sides now. And we just stand in the middle and just take it. So make a plan for what you're going to do with your interest rates. If you've got to make a transaction and you're going to own or hold your home for a while, or own or hold that real estate for a while, just bite down. If it makes sense today, it'll make better sense down the road. If you're waiting for interest rates to drop to 3%, got news for you. Not going to happen probably in our lifetime again, unless there's a major catastrophe. So you don't want the circumstances that would generate the crashing of interest rates. You want interest rates to be relatively stable. And that's where they are right now, between 5.5% and 7%. That's where they've been for a while now. Don't really expect them to go up that much higher. Don't really expect them to go that much lower. So make your plans for interest rates to be about where they are now in 2026 and 2027. Do I hope they go down? Yes. Can I plan that they go down? No. Am I going to bet that they go down? No, I don't really go out there and bet, no matter how much they try to prompt me on every single TV show that I watch. So remember, if you want to make prudent decisions in an interest rate environment that's unpredictable, make them with your stomach. If your stomach and gut tells you not to do it, don't do it. But if you need some cash, call me. I can help you pull out some cash from your home, from your real estate transaction. And remember, whenever you call me, it's always all about you. I want to thank our friends at Miami Podcast Studios. I want to thank our friends at Warren Henry Automotive, our other sponsors, the University of Florida Center for Real Estate Studies. I love them. And love coaching the kids, helping the young people get jobs. It's really wonderful and very fulfilling to do that. So everybody out there, go out and be a mentor. And remember, the person who wants to do something finds a way. The other finds an excuse. Now go out there and make